So stock prices are going down again. The S&P 500 is down 3.5% from the high, and the Nasdaq is down over 6% from its high. So the million-dollar question is, how much lower can this decline go? And is this once again a buying opportunity for investors or a time to stay away or even sell? Let's find out more in this video. Now, in the last few weeks, in my past videos, I've been saying many times that the market is due to go down, is due for a pullback or correction. So now that it's happening, it's not entirely unexpected. We expected this. But of course, for many new investors, they see suddenly stock prices, coming down for 2 weeks, they start to panic. Like, is this normal? Why is this happening? Now, the reason it's happening is because, very simply, the stock market is like an entity. It's like an entity, right? It has to breathe. It breathes out, then it breathes in. It breathes out, it breathes in. It can't breathe out forever. It can't go up every day, every week, every month. It goes through these wave patterns. Now, there'll be people who tell you that, oh, the reason the market went down is because of the Fitch downgrade of US debt, because of the rise of the 10-year Treasury yield, because of higher than expected PPI inflation data. Now, you find that whenever the market moves up or the market moves down, people like to give reasons why it did, And to me, over the years, I find that all these reasons that are given is full of bullshit. It is total bullshit, okay? Because whether the market goes up or down, you can always find a reason to justify the movement. To me, the reality is that the market goes up and down purely because it's a cycle. Prices always go through ups and down cycles. If the market wants to go up, it will go up regardless of all the bad news. If the market wants to go down, it will go down regardless of all the good news. And that's why I keep saying to my students, ignore the news. Ignore all these reasons. They are a complete distraction. Just focus on the price action of the market. Focus on fundamentals of individual businesses, the intrinsic values, and everything else is noise. If you just focus on what's important, you will do really well. So let's come to that million-dollar question that people are always asking. How much lower can it go? Where's the bottom? Now, the fact is, nobody knows. Nobody knows. And if people out there tell you that, I know where's the bottom, I know where the market's going to reverse, they are bullshitter. Because realistically, no one knows. All we can do is we can make educated guesses based on historical statistics. That's all you can do. Okay, and if you're a trader, you wait for those levels to be reached, wait for confirmation of reversal patterns, you enter with a stop loss of a profit target. If you're an investor, once you hit certain levels, you start averaging in your position. That's the best you can do, but you can never predict exactly where's the bottom or where's the top for that matter. So having said that, let's take a look at history. Let's look at statistics to see where could be the bottom, where could be these support levels. Yeah. So first of all, those of you who are new to the markets understand that these price declines are normal. They happen. Just as your wife or husband goes through bad moods and good moods, the market goes through wave up and wave down patterns. So over here you can see for the S&P 500 over the last 70 years, how often does the market drop 5% or more? Well, this happens 3 times a year. Okay, so in any year, the market will drop 5% or more at least 3 times a year. That's the average, okay? Now, how often does the market drop 10% or more a year? Well, that happens about once every year. Every year, yeah? And the market drops 15% or more a year once every 3 years. So these are useful statistics to know, right? And the market drops 20% or more, we call that a bear market, that happens once every 6 years. So on average, every 6 years we get a bear market. But it doesn't mean that it must be exactly every 6 years. Sometimes bear markets come close together and sometimes really far apart. So as you guys know, we had a bear market in 2020 because of the pandemic, unexpected, and then another bear market that was induced by the Fed in 2022. So we had 2 bear markets in just 4 years, to me, our quota for bear markets are done, right? So there's going to be quite a long time before the next bear market, in my opinion. So like I said, we are in a bull market, and I do expect this bull market to last for at least 5 to 10 years. But remember, within this bull market, you're going to have these 5%, 10%, 15% declines along that journey. By the way, anything less than a 10% decline, that's called a pullback. Anything more than a 10% decline is called a correction. So currently it's not a correction yet. Currently we're down 3.5% on the S&P 500. That's just a pullback. So should you be fearful or frustrated about these pullbacks and corrections? No, don't be fearful, don't be frustrated, don't be worried, because they are part of the game. Expect it. If you expect it, it won't affect you emotionally. It's kind of like you gotta expect it will rain once in a while, right? It's called the water cycle. If you are married, your husband or wife will get into a bad mood once in a while. So expect it. Don't be frustrated or angry by it. The thing is to take advantage of it. So I tell my students that when these pullbacks or corrections happen, take advantage of it. Use the opportunity to add shares of high quality businesses, of high quality stocks when they get undervalued again or when they retrace to support levels. If you're simply buying the index ETF, wait for the retracement to support levels to add shares. If you're a trader, wait for the price to reach again certain support levels, wait for a reversal price action pattern. Like you look at the Bollinger Bands, you look at candlestick patterns, you take your buy entry and you place your stop loss, take your profit target. There's lots of opportunities. If you're an options trader like me, once we see price goes down, volatility goes up, we sell options like put options or bull put spread options to create high levels of premiums, and that's how we generate a lot of income in the market. So take advantage of it. Now, for people who say, but Adam, I got no more money left, what do? I can't take advantage. Then ignore it. Either take advantage of the market or ignore it, because any decline is always temporary. If you hold good quality stocks or you hold the index, it always goes up. It always goes up, right? So again, I love to show these charts. If you're a beginner, this will help you to look at the big picture. If you take a look at the long term in the markets, now this is over 122 years. And despite, two world wars, a Great Depression, a financial crisis, Asian financial crisis, a dot-com crash, and US government shutdowns and all kinds of things, right? In the last 122 years, the Dow Jones Industrials average, now I'm using the Dow Jones because only the Dow Jones has a 120-year history, right? The Dow Jones increased 38,000% over 122 years. So that is roughly about 7% annualized return on average through the ups and downs. So regardless of all these crashes, your wealth is growing at 7% compounded every single year. Now this is over the last 122 years. If you take a look at the last 20 years, which is a shorter time frame, you can see that the S&P 500 gained 548% in the last 20 years, and that's about 9.79% annualized return. If you take a look at the last 10 years, from 2013 January to 2022 December, not even counting this year, right? Even after this financial crisis, dot-com crash, COVID pandemic, last year bear market, despite all these crashes, the S&P 500 is up 221% in the last 10 years, and that's about 12.4% annualized returns, just holding through those ups and downs, all right? Now, so notice something interesting. Over the last 30 years, the annual return was about 7%. Over the last 20 years, it was about 9%. Over the last 10 years, it was 12%. So what do you notice? Not only does the US market always go up, but it's going up at a higher return every decade. The reason is because companies' profits are increasing at a higher and higher rate because of productivity, because of lower costs, productivity gains, and of course, profit margin increases. All right. So I do expect the next 10, 20 years for the returns to be even higher because of, again, generative AI, automation, driving productivity gains, driving earnings growth, which I talked about during the 6-wave webinar. Now, of course, getting a 12.4% annual return in the stock market is what I call the idiot's way of doing it, or the complete moron's way of doing it. Because to do this, you don't need any financial knowledge. You just have to buy the ETF of the S&P 500 or the Dow Jones or the Nasdaq and just hold it through the ups and downs and do dollar cost averaging. But of course, if you learn how to pick only the highest quality stocks, the top 1% of companies in the world, and these are companies that I buy, right? We call them the UIP stocks. Why UIP? That's my Ultimate Investors Playbook, where I handpick these high quality companies for myself and for my subscribers. So these are companies with a wide economic moat, with consistent growth in revenue, profits and cash flow, with high return on invested capital, high ROE, low debt. They meet all my criteria for a great company. And again, you can learn to do this yourself, right? You can take my investing course and find your own great companies, or in UIP, basically, I find these stocks for you. So if you only invest in a portfolio of these UIP stocks or high quality businesses, you get much higher returns than just the index, right? For example, in the last 10 years, you can see that a portfolio of some of my UIP stocks, these are the ones in my portfolio. I've got more, but these are just some of them. Like, for example, Microsoft, all right? And notice that these are stocks that are across different sectors. So I'm not picking those very popular stocks like Nvidia and all that. No, let's leave those out. Let's pick those really safe and high quality companies that are still relatively undervalued, right? Across different sectors. So it's like Microsoft is from the technology sector, United Health is a healthcare company, Apple is consumer electronics, ASML is semiconductors, Domino's Pizza is a consumer staple company, Pool Corporation is an industrial company, Thermo Fisher, another healthcare, S&P Global, MasterCard are financial companies, Lowe's is a consumer discretionary DIY home building company like Home Depot, right? So holding a portfolio of these high quality stocks in the last 10 years, you would have way outperformed the S&P 500 and the Nasdaq. So you can see if you take a portfolio of these stocks, it way outperforms the S&P 500. In fact, a portfolio of these high quality businesses, last 10 years you would have gotten 841% gain, and that's about 25% annualized return. Now, those of you who have been watching my social media posts, you would have seen many of my students sharing their testimonials over the years. Like Roman was a recent student of mine where he got 42% return year to date. He said, almost 2 years ago, I enrolled in your VMI course, that's the Value Momentum Investing course, and now in my second year of enrolling into the UIP Ultimate Investors Playbook, I think it is the best investment I've made in the last 10 years. Besides getting married, right? So it's up 42% return this year. People like Adam Khoo, who attended my class back in 2016 and 2017, is about 7 years ago, getting 47% return this year. And people like Felix, who's up like 165% return this year. So many of my students and even myself, we're getting much higher than 25% a year, getting like 30, 40, 50, some 100% return a year, because besides buying the best companies, we also turbocharge our returns by using options. And again, that's what you learn how to do in our options classes, as well as swing trading using price action manipulation and swing trading strategies, right? So the whole point is to not fear the ups and downs of the market. Again, take advantage of it or ignore it. And if you cancel out the noise around you, ignoring all the news and all the stuff like that, you will do really, really well. And I keep telling people that, to make a great return in the stock markets is actually very simple. It is actually so simple. But most people can't do it because their emotions get in the way. The greatest enemy is their emotions. And your emotions come from reading all this news, which is mostly manipulated. A classic example that happened last year, if you guys recall, the bear market bottomed in October 2022. That's the time we were buying aggressively. I told you guys that we started a bull run, right? But Very few people believed it. Very few people invested. Why? Because they read the news that is always manipulated. Now, what happened? Take a look, right? On 19 October, if you read the news, right, Bloomberg forecasted 100% chance of a Biden recession. Talk about being political, right? They said, despite experts sounding alarm bells, the Biden administration is in denial, right? So think about it. Imagine you read this article that says 100% chance of recession, you freak out and you sell right at the bottom of the bear market. Or worse, some people, not only do they sell and get out of the markets fearing recession, they even short the markets. You know, I know a lot of people who shorted the markets and said it's going to collapse. But what happened after this article? Boom, the market goes up 22%. You know, and after the market goes up 22%, now the media says, ooh, we are sorry, we were wrong, right? Now, on 3rd of August, Bank of America says we are reversing our recession call because of strong jobs and spending, okay? That's why I keep saying that the only person who can cause you to fail in the markets is yourself. You know, people, when they lose money in the markets, who do they blame? They blame everyone. They blame their broker. They blame the expert who made predictions that they listened to. They blame God. They blame their luck. They blame the market makers. They blame the high frequency algo traders. They blame the chicken. They blame the whole world. But no one's to blame. The only person to blame is you. Right? So if you take ownership, stop reading the stupid manipulated news, right? And don't get emotional through ups and downs. Focus on holding only great companies that meet all our top 1% criteria. And you take advantage during these corrections and you learn to trade options around the positions, you will do well, regardless of bull markets and bear markets. Now, let me address some very common questions that people ask me. First question is, so you're saying that I should buy shares during a pullback or correction, shares of great companies, but exactly when do I buy? Do I buy now or do I buy next week? You know, where do I buy, right? Now, first of all, a lot of people, they want to buy at the bottom of every decline. Let me first say that is impossible. No one knows where the bottom is. And if you always have this mindset that I want to buy at the bottom, you will never buy. You will never buy, because if it drops on a certain day, you're going to say that it's going to go lower. So I'm going to wait for tomorrow, right? So you won't buy. Then if it goes up the next day, you say, why should I buy? Because it was lower the previous day. Let's wait for it to come down again. So you will never end up buying. So forget thinking you can buy at the bottom, okay? As long as you buy when the price is undervalued, it's selling below the intrinsic value, that's good enough. So the important thing is to know what is the intrinsic value of every stock. So that's what we teach in our value momentum investing courses, to calculate the intrinsic value, so you know whether something's expensive or cheap. Now, again, if you're too lazy to calculate yourself, you can join the UIP, where I will calculate all the intrinsic value of all the great companies every month. It's updated. But let me give you an example. Like, look at Apple as an example. Now, Apple, since the high, it's down about 10%. So people are wondering, should I buy now? Should I wait till it goes lower? No one knows where's the bottom. But what's the intrinsic value? So if you do a simple discounted cash flow valuation, which is again over here, you can see using my intrinsic value calculator, and you can see we are taking the last 12 months cash from operations. We project it for the next 20 years to find out how much cash Apple will generate for the next 20 years. We take the total debt of the company, 102 billion in debt, 62 billion in cash, and then we put in a growth rate of the company. Now, how do I get this growth rate? Basically, I look at different websites that kind of like have a consensus of the analyst projections. We take an average of many websites, of many analyst projections, and it's about 9.3% projected growth of Apple. Okay, and then we put in the number of shares. We use a 7% discount rate, which is my model, and that gives us an intrinsic value of $155. So once you do the valuation, you know that Apple is worth $155. It's a fact. It's as simple as that. So to be safe, we want to buy at or below the valuation. Okay. Now the current share price is $177. So if you want to buy today, you can. I'm not saying you can't, But if you buy it today, you're paying a 14% premium over the valuation. So as an investor, I've learned to discipline myself to say, I don't care if it's going to go up tomorrow, but I will only buy if it is fairly priced or underpriced. That's how I get a margin of safety. Now, a couple of days ago, on the 7th of August, I posted on social media that, come to Papa baby, because I want to add more shares of Apple. I already have quite a number of shares that I bought at a much lower price. I think my average cost is about 130, right? And I want to add more to my position. So I said, come to Papa baby, and I put a chart here saying that I ideally want to buy when the price goes down below the intrinsic value to 144 ideally. A couple of Apple bulls got really upset with me, like, Adam, how do you know it's going to go to 144? What makes you think it's going to go down? How can you predict that? Hey, I'm not predicting shit. Remember, I keep telling you that no one can predict where's the bottom. No one can predict whether the price will go up or go down and how low or how up in the short term. And whoever tells you they can predict is a bullshitter. So by showing this chart and saying this, am I making a prediction it's going to go down? No. I've got no idea whether it's going to go down to that level or lower or go up tomorrow. I've got no idea. But all I'm saying is that I will only buy if it gets to that level, because that's the discipline as a value investor. So if you take a look at this chart over here, now again, why do I put that level? Very simple, because what's the intrinsic value I calculated? $155. That's it. So I will only buy at 155 or lower. Of course, the lower the better, right? And I draw what we call these support levels based on historical support levels, swing lows, and moving averages. And notice that for every stock, I've got at least 4 levels, right? So for example, Apple, I've got 154, 144, 134, and 124. So what I do for my subscribers is every month I will update these 4 levels for every stock that I am buying, okay? So why 4 levels? Because since we can't pick the bottom, when we buy a stock, we always average in our position. We always buy in tranches. We don't buy at one go. So if it drops to the first level, I will buy a bit, right? Say a quarter of what I want to buy. If it goes to the second level, I buy another 1/4. So I keep averaging in my position. And if it drops all the way to the last level, which is the previous swing low, then I enter my entire full allocation, which I intend to enter this year. That's the discipline. I'm not saying it's going to go there because I don't know, right? It could go down here and then go up. And in this case, I don't buy, and that's fine, okay? Never chase the girl. Wait for the girl to run to you, to your arms. And if the girl doesn't come to you, go find another girl, right? So if I don't get a chance to buy more Apple, that's fine. I'll go buy more Microsoft, more Amazon, something else that comes to me. I don't have to buy Apple. Now, just bear in mind that if you want to buy Apple at today's price of $177, it's not wrong. I'm not saying it's wrong. It's just a bit more risky because you're overpaying for something. Now, of course, over time, a great business like Apple, the intrinsic value will rise as well, right? Right now, the valuation, the intrinsic value is about 155. It will go up in time. So if you overpay, eventually it's okay because the valuation will rise. But again, to me, my discipline is I like to buy when it's undervalued, okay? Now, some of you may say, but Apple, I may not get a chance to buy because, it's so far from the intrinsic value. True. And that's why we've got many other great companies that are nearer their intrinsic value. So let me give you a few more examples. Like Microsoft is another great business that I own, but I want to buy more shares as well. Now, if you look at Microsoft, and if you do the intrinsic value, Microsoft is actually a bit cheaper, if you will, right? So my valuation of Microsoft is actually $341 intrinsic value. So actually Microsoft is now undervalued, okay? Is now actually undervalued. Now, I actually have got, again, my 4 buy levels that I have indicated, which is my support levels 335, 319, 300, and 285. And you can see that Microsoft is down about 10% from the high. Okay, so down about 10% from the high. And it's actually retraced to the second level of support. So Microsoft is actually at quite an attractive buy level. Now, whether an investor should buy more Microsoft right now depends on how much they already have in their portfolio. So for example, if you have got no position in Microsoft, it'll be a great time to add right now. If you have got a bit of a position, also a good time to add right now. Now, if you already have a big position, like me, I've got quite a big position, then I play more hard to get. Then I only want to add only if it reaches the third support level or the fourth support level. So it all depends on your current allocation. These are things that I show my students every single day. And again, bear in mind that the intrinsic value will keep changing. Great company, the valuation will keep going up over time as the company makes more and more free cash flow, right? And these support levels will change over time as well. So I update them regularly every single month. Now, let me show you a stock that I know is very popular, which I own as well, which is Palantir. And if you look at Palantir, people ask, is it time to buy again? Because it's gone down quite a bit, right? Palantir, I think it's like down 25% from the high, right? So my intrinsic value of Palantir is within a range, okay? So my base case valuation is $16 and my conservative valuation is $13, depending on what kind of growth rate you're using, right? Now, I must say that the recent report that came out for Palantir was a bit disappointing because their revenue growth was lower than what I expected, okay? So because of that, I may be more inclined to take the lower valuation of Palantir, which is about $13 valuation, right? So in other words, Palantir may only be a good deal to add more, only below $13 or near $13, because 16 is the more optimistic valuation based on a higher revenue growth. But of course, if you believe that Palantir can re-accelerate the revenue growth in the next few quarters, then sure, go for $16, right? So anyway, you can see same thing. I've added, these 4 levels, $15, $13.53, $11, and $10. And again, you want to average in your position. So remember that averaging in a position is only for investing. When you're investing in a stock for the long term, you're kind of like getting married, right? But I know some of you may be more swing trading, which is like a one-night stand. Now, if you're a swing trader, then of course intrinsic value is not important, because a one-night stand, you don't really care about the person's character, right? You just play with the emotions, if you will, So for trading, which I do in a separate portfolio as well, then it's all about the price action. You're waiting for, after the retracement, waiting for a reversal pattern. So you can wait for like a double bottom pattern like that, or wait for a bullish candlestick pattern, like a bullish engulfing, a bullish pin bar, and then you enter once you got a confirmation of a reversal. And of course, these are things that we cover in our stock trading course and price action manipulation course. But for trading, remember, one night stand, always use protection. Always use protection for one night stand, right? So if you enter based on a price action, always have a stop loss below the previous swing low, have a set profit target to get out, right? So you're risking 1 hour to make 2 hours. Yeah, but if you're getting married to the company, like me, I'm a long-term investor, then there's no stop loss, no protection when you're married. That's right, because it'll always go up eventually. It's a great company, and you hold it even in short-term declines, right? And for investments, I only sell only if the fundamentals of the business deteriorates, which is not easy. If you buy a great company, it's very hard for the fundamentals to deteriorate, right? Or if it gets ridiculously overpriced, like double the intrinsic value, I'll sell half the position. Like Nvidia, right? I sold some of my Nvidia because it was way overpriced, but I'm still holding right now I'm holding about 40% of the position and just letting it run. Although it's still very overpriced, I'm not buying more Nvidia, but I'm just holding my balanced portfolio, right? So I hope that this has been a video to kind of like highlight to you how as investors we deal with these short-term ups and downs. And before I go, let me answer another common question people have, which is, Adam, if you know that the market was going to go down, like you said in the last few videos, why didn't you sell at the top and then buy back at the bottom? Isn't that smarter? Well, here's the problem. In retrospect, you may say, I should have sold there and I buy back here, right? Now, in retrospect, of course, it looks like you can do that. But in real life, it's impossible, okay? It's impossible to time the absolute top to sell and the absolute bottom to buy. Now, I can tell you that I've been in the markets for 31 years and I've tried this shit before. I tried to jump in and out of stocks, right? If it goes up, I sell, go down, I buy. I did that before. I did that with many, many stocks. And I made money along the way. But when I look back at my last 31 years, I found that if I didn't do that for the high quality companies, if I didn't jump in and out, if I just stayed inside, I would actually have made a lot more money. Okay? Because the danger with jumping out and jumping in is many times when you try to get back in, you tend to get back in at a much higher price. Okay? Why? Because very often what happens is that, right, the price goes up and you think, okay, that's the top, right? Because things are overvalued, right? And you sell, what happens? Oftentimes it keeps going up. Ah, shit! Right? And then it drops, yes! But and then it goes off without you, you know? And then by the time you get a chance to buy it back, you know, it would have gone up so much that you would have been better off just holding it, you know? And then sometimes it may go up and then you sell, you think it's the top and you were right. It goes down, yeah, I'm so smart, but when do I buy it back, right? And then when it goes down here, you say, you know, should I buy it back? But it could go lower, right? And then you don't buy it back and it goes like that, boom, oh shit! Oh, fuck. Okay, I tell you what, I can't buy it back now, right? Wait for it to pull back again and then boom, it goes up. Ah! And that is what happened to me many, many times. You know, I remember years ago, you know, I sold Domino's because it's overpriced and then a bastard kept going up, right? By the time I bought it back, it was so much higher. Same thing with Apple. I sold Apple. I thought it was high, went even higher. And if I just kept Domino's, I just kept Apple, I just kept Microsoft, I kept Amazon in the last 10, 20 years, today I'll be so much richer. And that's why today I don't bother to try to jump out and jump back in my investment. I just hold it because over time, you will do a lot better, right? I love to use this analogy. If you have married a fantastic wife or husband, that's a great wife that you know they will keep increasing in value over time. If they are in a bad mood, just stay with them. You know, just stay with them, right? A lot of people, they think, oh, my wife is going to get into the bad mood because she's at a peak. She's going to start to get in bad mood soon. So they run off to the pub to avoid the bad mood. And they say, I'll come back when she's in a good mood again, right? To catch her at the bottom. But the problem is that you run off to the pub and by the time you come back, she's not there anymore. She ran away with your best friend who was there to console her. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.